All right, we are now recording. So what I want to do is I want to go over homework 2, which was due this morning, and obviously will be a topic on next week's midterm to make sure we understand the conversion process and what it is telling us. Homework 2 is obviously more complicated than the in-class example, and it gets to look more like traditional financial statements that you will see and be dealing with on the future basis. So basically, uh, what we had done for homework 2 is we take this hypothetical company with 3 years, and we have obviously all the labels here. And what I want to do is convert it to economic statements. So again, the recommended process was to create a new statement for each tab. So I'll start out with the balance sheet. And again, it doesn't matter if I do the balance sheet or the income statement first, because ultimately I have to do both statements before I do the CFI. But I'll need the income statement and the balance sheet converted in order to do CFI. Again, in Excel, we want to use relative references just so it's easy to copy and paste over. So in this case, I'll copy and paste over my years. And I also want to carry over my label column as well. All right, so with the balance sheet, the key to the balance sheet, we discussed this in class last week, is we want to take all of the items that are operating and put them together. And that is what we were calling invested capital. Break the slide just as a reminder. So we're going to take all of the operating assets and net them against the operating liabilities, or using the convention we spoke about in class, everything that we label as one, and then net those ones against each other. And we'll do the same process for the rest of the balance sheet, all of our 2s, 3s, and 4s, the non-operating items, the debt equivalent items, and the equity equivalent items. So my first process here as I convert these statements is I want to go back and look at anything on the balance sheet that is a 1. And again, I have new categories, but anything defined as operating, I'm going to put into my invested capital. Now, a couple things about the balance sheet. One is you'll notice there's something here called excess cash as opposed to operating cash. And that's a distinction that we are going to make when we evaluate a company. And the idea is that a company needs a certain amount of cash to run its business day to day. So companies don't go bankrupt when they hit zero cash. Companies go bankrupt before they hit zero cash because they need a certain amount of cash to run their business. A few years ago, when General Motors went bankrupt, they actually said that $10 billion was the threshold that they were going to have trouble operating their business on a day-to-day basis. So when the government ended up bailing them out, they didn't bail them out when they hit zero. They bailed them out when they were getting very close to their $10 billion cash limit. So again, how much operating cash is difficult to quantify as an external person unless you really know the business and the industry. So what we're going to do, and the book talks about 3 methods for figuring out operating cash, is we're going to use one of them, which is the 2% rule. And we're going to say 2% of a company's revenue, which is approximately 1 week of time, 1/50th of the year, is the amount of cash need to run the business day to day. Now, again, that number could be far higher for certain companies. General Motors was an example, because at the time they were about 160 billion, I think 150, 60 billion. So 10 divided by 150 is higher, a little bit number higher than 2%. But as a general rule, we're going to say it's at least 1 week of cash. So we're going to take the company's reported cash and cash equivalent balance, and we're going to split it into operating cash, 2% of revenue, and everything else goes into excess cash. Now, on this assignment, I've done that for you. And anything that's excess cash, we're going to label as non-operating or a 2. And the idea is that even when you use a principle of what's called net debt, it's the excess cash that can be paid out. The operating cash can never be paid out. So it's a misnomer to say that if a business goes bankrupt, all of the cash is available to pay off and be paid out of the business, because that's not practically true. Some of that cash is going to still be tied up day to day even in a bankruptcy provision, you're going to have lawyers, you have judges, and the courts are going to get paid off, and creditors before the debt holders and shareholders. So essentially, we have to think about net debt being net of the excess cash, net of the operating cash, as we go through this class as well. Again, a minor nuance versus what you might encounter elsewhere. But back to this. So what I need to do, regardless of the labels, the categories, is put all my ones together. So my one assets, and I'll do the working capital ones first. Anything current. So in this case, it was my operating cash. It was my receivables. It was my inventory. And it was my other current assets. Those are my current ones. And then my current liability ones, accounts payable and other current liabilities. Again, that's another nuance of this definition of operating current assets, is that we exclude short-term debt or current portion of long-term debt, because that is a debt equivalent cash flow. So even though it's in current assets, current liabilities, and even though a traditional accountant would call that working capital, current assets minus current liabilities, in this class, we're defining short-term debt as debt equivalent, a 3, and so it's not part of working capital. So I think I have all of my ones. And if I've carried over my labels correctly, I'll see all my ones labeled over there. And essentially what I've created is, and just to differentiate between the accounting definition, we'll call this operating working capital. So it's my operating assets minus my operating liabilities. And to that, I add any long-term ones. So in this case, PP&E, goodwill, and the other assets, other miscellaneous assets, are also labeled A1. Any of my long-term ones. And then I look to see if I have, just like I did in working capital, any operating liabilities that are non-current. So in this case, I have other long-term operating liabilities. So just as I had done with, we'll call this actually invested capital, with the operating working capital, invested capital, I need to now sum all of my one assets minus my liabilities. So I'll take my, actually copy and paste this over first. Sum all of my assets. So working capital plus PP&E plus goodwill plus other assets minus the operating liabilities, and that would give me my invested capital. Okay, so again, we're netting in the process, and that's very important. And then from here, what we're going to do is we're going to take any non-operating items to get TFI. So if I go back to my financials, I look for anything labeled A2, that is an asset. So in this case, excess cash. And then I have anything labeled as a 2. I have equity investments. And on the liability side, so I'm going to net out anything labeled as a 2. I have some other long-term non-operating assets. Non-operating liabilities. That's it. Okay. So that, when I copy and paste over, should have the 3 2s. Get my labels there. So that would get me to TFI. And my TFI is going to be any of my invested capital plus my 2s, so my assets, add in the excess cash, add in the equity investments, subtract out long-term liabilities that are non-operating. And then I finished one side of my TFI. Now I need to go and do the debt and the equity side, or the what we call the funds flow or the financing side of TFI. So in this case, I'm going to go equals anything that is a 3 and 4. So now I'm going to look for my 3s on the balance sheet. And in this case, I see I have my short-term debt. I have my long-term debt. And then I look and I see if I have any 4s. In this case, I have minority interest, preferred stock, common stock, retained earnings, and treasury stock. All are 4s. So I take my minority interest. All the way through treasury stock. Copy and paste this over. I have my 3s and my 4s. And then I just add up the 3s and 4s. And hopefully my TFI balances. So again, structure of the statement. We basically have this amount of capital or cash that is tied up to run our business day to day. We have this amount of cash that is tied up in our business that is not being used to run the business day to day. It just happens to be in our business. We add the two together. We have the total amount of cash that needs to be financed by people that require a return on their investment. They are the debt and the equity finance holders. So that financing is that investment, which goes into the operating items and the non-operating items. That is our rearranged balance sheet. Now we want to rearrange the income statement. So again, TII. Same as the balance sheet. Copy over on a new tab. Use relative references, make your lives a little bit easier. And we said that one of the shortcuts we would take on the income statement is we could start with EBIT or operating profit as the net of the ones above it. Right? So again, all the items above are operating items. So rather than getting down to EBIT or operating income, we could start at EBIT or operating income. Right? So here is my EBIT. And we talked about taxes. So again, I'll write this on here so we can see. So we have my tax on the EBIT. And what's key here is we're looking at what are called the operating taxes, right? Or the taxes we would pay if that is the only amount of money we reported as earnings. So if I look here, and the tax rate, you'll notice, will vary from example to example. So don't always assume we'll use a 25% tax rate. In this case, it's a 30% tax rate. So what I'm going to do is take the EBIT, multiply by 0.3, 30% taxes, and then I have my NOPLAT or my NOPAT, which is my EBIT after tax. Okay. And again, book calls it NOPAT. Other people call it NOPLAT. Those terms are interchangeable. But the idea is it's my operating profit after tax, right? So that's my operating cash flows from the income statement. Now I need to look at my non-operating cash flows from the income statement. In this case, do I have any 2s? So I see that I have interest income, which is a new category for this, and I have non-operating gains or loss. So interest income and non-operating income. So here's what we're going to do. And I'm going to write it out in full just so it's easy to see what's going on. I'll start with my interest income, which is my first 2. So if I have this much interest income and I report that to the IRS, I would have to pay this much tax on the interest income, which is 30% of it. So my after tax interest income equals the pre-tax minus the tax effect. So again, as investors, we expect to be paid after taxes are paid. And so therefore, when we're looking at this view, we have to look at the tax effect of all the items. In this case, the tax effect appropriated to the right part of the Midi-Clowney-Miller model. So we're looking at the tax on the interest income portion and then breaking it out to after-tax interest income. Now again, as you get more familiar with these statements, if you want to just take the number times 0.7, that would be fine, but it might be helpful to continue to see how we create these statements by breaking them out. We do the same thing with any other two. In this case, my next two on the income statement would have been the non-operating gain or loss. Again, we generally know this is pre-tax because it's listed above taxes. So copy and paste that over. And same thing, we have the tax impact on the non-operating income or loss. So equals that times 0.3. And then I'll carry that over. So I have my after-tax non-operating income. I believe those are the only twos on the income statement. So from a TII perspective, what I would then have is my total income available to investors would be any no plat plus the after-tax interest expense plus the after-tax non-operating income. And that would be the income available to pay, to the investors. Now, how is that income distributed to the investors? I want to look at my 3s and my 4s. So any 3s on the income statement? In this case, I have interest expense. Now, we talked about the convention for this. This has to align to the income available to investors. So I have to flip the sign because payouts are positive. The idea that if I make money, I can pay it out. I'm going to have a tax shield because I can tax deduct the interest expense. In this case, I'll multiply it by 0.3. And where that came from. And I'll have my after-tax interest expense, which is the interest expense minus the tax shield. Right, so make sure I get the formula right here, 0.3. Okay. So if I check to see if I have any other 3s on the income statement, that was my only one. And now I look to see if I have any 4s. And so in this case, I have minority interest, which comes from the minority interest on the income statement, which comes from the minority interest in the balance sheet. Now, brief word about minority interest. This comes from accounting. So the idea of minority interest is that when we make an investment into another firm that we don't control, it is called an equity investment, right? It's non-operating. Now, the flip side of that is that the company that does control the asset would have to report our investment on their balance sheet because our investment isn't into their entire company. It is into the piece of the company that they control. So the amount of money that we have invested into part of their company as opposed to their whole company, which would be a common shareholder, is called minority interest. That's called the minority stake. So that represents, for the company that we've invested to, basically a non-controlling stake in assets that they control, that they owe to those other shareholders. So it's kind of like a liability to those other shareholders. And the idea of minority interest is that we owe not all of our earnings to those other shareholders. We only owe the earnings, a piece of their earnings based on their ownership stake in the business that we both are invested in, or it could be other people invested in as well. And that's what they're entitled to. The payout of the cash flows, kind of quasi dividends from that minority stake, because they don't get all of the profits, is called minority interest on the income statement. So this is the payout to the minority shareholders because they get some of the investment income for the assets that they don't control that we do. However, they don't get profits on our entire business, so we segregate it out, and that's what the minority interest on the income statement represents. So in this case, this is a payment to the minority shareholders. Right? So back to our Excel here. TII. Fours. My next four is my minority interest. And that is a payout. So if it's paid out, it's a positive number. So I flip that sign. Now, here's the difference about minority interest. Minority interest comes after taxes are paid because the company that controls the business pays the taxes. And so this is an after-tax distribution to the minority shareholders, so we don't have to take a tax effect on the minority interest. And so again, just as a general rule of thumb, items on the income statement above the tax line are generally pre-tax. Items on the income statement after the tax line are generally after tax. And so therefore, since minority interest falls after the taxes have been paid, we don't want to put double taxes on here. So back to the TII. Last four is the net income. And remember, even though I put dividends on here, the income statement actually stops with net income. So that is our last of our fours. And so now I'll add up my fours. I'll take my after-tax interest expense, sorry, threes and fours, after tax, which is already tax-affected minority interest, and add in my net income. And if I didn't make a mistake, my TIIs should balance, total income available to investors. So generally, I have that much income from running my business, selling my products and services on an operating basis to customers. I have that miscellaneous income from things that have nothing to do with selling products and services to customers. But it's income to me. I add the two together, total income available to investors. This is the amount of money that I can pay out to my investors. Here's what I pay out in financing. Here's what I pay out to shareholders and debt holders. And the two have to add and have to sync. Hopefully on your homework assignment, you mostly got these two statements right. Now we go on to the more challenging statement, which is the CFI. So CFI, or cash flow available to investors, is the statement you would have needed to do after you converted the income statement and the balance sheet. Because the idea of the cash flow statement is cash flow is cash coming from the income statement minus cash reinvested in the balance sheet. And so we are going to do that 4 times. We're going to do that for the operating items. We're going to do that for the non-operating items. We're going to do that for the debt equivalent cash flows, and we're going to do that for the equity equivalent cash flows. So income statement minus balance sheet, or at least change in balance sheet, equals the item on the CFI. So we'll start out with the first one, which is the operating items, which get us to free cash flow. So free cash flow is defined as gross cash flow, which will start with the TII, which is the note plat, add back the non-cash items on the income statement, which in this case would be depreciation. And that would get us something called gross cash flow. So those were my ones. Since I'm adding back depreciation, I'm just going to flip the sign here. And that will be this plus this. So here's how much gross cash flow I'm generating from the income statement. And then what I want to do is I want to subtract my gross investment. So again, I gave you a shortcut and I gave you sort of the long way of doing it. We'll start out with the long way. First, I have my change, from a change in the balance sheet. So change in operating working capital. Now, here's the other thing. Because I need this change in my data, I can't do 3 years worth of cash flows. I can only do 2 years worth of cash flows because I need the beginning and the end to get the change. So even though I have 3 years of balance sheets and 3 years of TFI, 3 years of income statements and 3 years of TII, I can only do 2 years of CFI because I need the change in the TFI to get the CFI. So in this case, my change in working capital between 2010 and 2011, working capital went down. And that's operating. Next, I have my change in my other ones on the balance sheet, PP&E, goodwill, other assets. So again, change in PP&E is called capital expenditures, CapEx for short. Again, to solve for CapEx, what we would do is we would take the ending net PP&E, since we're dealing with net, not gross. We would subtract the beginning PP&E and we would add to it the current year's depreciation. And I think I have that in the wrong column. All right, copy, paste, 1. Right. Then, make sure I did that right. So C10 minus B10. C minus B, yes. All right. Next, I would have any other changes in my other ones. In this case, change in other assets equals current year minus previous year. These are also ones. And finally, in fact, let me label this change in other assets. And then I would have my change in other operating liabilities. So I have to account for the change in the assets. I also have to account for the change in the liabilities. So in this case, if I go back to my TFI, I can see my other long-term liabilities went from 200 to 500, essentially saving 300 in cash by not paying those bills. So in this case, equals 500 minus 200. So my gross investment equals that plus that plus that, but I save that. So I spent money in working capital, I got it back, spent money on CapEx, spent money to buy other assets, save money with my operating liabilities. Now, just to check, I can also do the shortcut gross investment, which equals the change in invested capital. So current year minus previous year plus the current year's depreciation. Where's depreciation? Here it is. All right, so what did I just miss? Sorry, it's early in the morning. Let's see, CFI. Oh, let me go back and look at my twos. Oh, never mind. Where did I screw up? Sorry, I was looking to see where I messed up. Oh, let's see. Check my labeling. Get all my ones. Oh, I forgot the goodwill. This is why labeling is important. So I left a Lego on the floor. Sorry for the long pause. But this is exactly why we do what we're doing. And in this case, what I left out of the aggregated part is I left out a 1. Because if you look here on the TFI, I have some goodwill and intangibles, and I don't have a good change in goodwill and intangibles here. So that's why my statement is not going to balance. And that's why I also recommend doing both methods, because of this exact answer. So when you have a brain freeze like I just did, and you can't figure out what you did wrong, follow the process. And part of the process is check all of your labeling. And so in this case, from a label, what I missed, I'll just add this here. Where was it in the list? After PP&E, I'll add it in the same place. So under CapEx, insert a row, change in goodwill equals current year minus previous year. Copy, paste, that's also A1. So now when I add in C8, there we go. So again, importance of using the balancing method. So back to this. I now have my free cash flow ready to be calculated, which is any cash from operating activities minus any investment, which in this case for 2011 was a negative investment. They actually got cash out of their balance sheet. So the difference between the two, free cash flow. So 2011, free cash flow was positive. For 2012, free cash flow was negative. All right, now I'm going to go through a similar process, hopefully without the mistake, on the income statement. And on the income statement, what I want to do is do my income twos. So add those in. After tax interest income, after tax non-operating income, There we go. Those are both 2s. So that's the cash that I'm generating on the income statement that were 2s. And then I want to look at any cash that I invested in the balance sheet that were 2s. So in this case, if I go back to my TFI, I look at my 2s. And I see that I have excess cash, I have equity investments, and then I have the other long-term non-operating liabilities as my 2s. So I want my change in excess cash. I want my change in equity investments, and I want my change in other long-term liabilities. Other long-term non-operating liabilities. So equals excess cash went from 265 to 370. That should be my change. Now, formulas. Got to pay attention to what's happening here. Excess cash went from 265 to 370. Once you think of excess cash as like a savings account, and think of operating cash as a checking account. We pay our bills out of our checking account. We don't pay our bills out of our savings account. So the idea is when I put money from checking to savings, I don't have the money in my checking account anymore to pay my bills. So it actually reduces the amount of cash flow available to pay out to my investors when I move money to excess cash. So practically, what that means for us is that when my excess cash increases, which it's doing in here, it reduces the CFI. So I'm going to have to flip this sign. So I'm taking cash away from my ability to pay investors because I'm basically investing it in a short-term non-operating investment. And that's a 2. All right, same thing with equity investments. When I increase my equity investments, I'm basically purchasing more equity stakes. That's using up cash. So that's going to be reducing my CFI. So since I'm going to be adding these together, I'm going to flip that sign. And finally, for other long-term non-operating liabilities, when my other long-term liabilities go down, that means I'm paying them off, which is reducing my CFI. So a negative change there is actually going to be showing a reduction of CFI. So I don't need to change that sign. So my cash flow available to pay out my investors should be the sum of the free cash flows from operating activities plus the non-operating cash flows. And that would give me what we call our CFI, or cash flow available to investors. And that is going to be financed. So again, I want to look at the cash flow to the debt and equity holders of the firm. So in this case, I'll start out with debt holders, usually pretty straightforward off the income statement. It's going to be the after-tax interest expense. So that's how much cash I'm paying out to the debt holders. Again, payouts are positive numbers. I don't have to do that. Next, I need a change in debt. So change in short term. And I also want to look at my change in long-term debt. So remember, the balance sheet is always about the change. In this case, TFI, short-term debt went from 80 to 240. And in the first year, the long-term debt didn't change. But let's think about debt. If I increased my debt from 80 to 240. Then that is an inflow of cash into the firm, not an outflow to the debt holders. So what I would need to do on the CFI statement is I'm going to have to flip this sign if I'm going to add these numbers together, because I want to represent that this is an outflow of cash. So an increase in debt is an outflow of cash, because again, I'm reconciling to the cash flow available to the investors. And if I borrow money from investors, I'm taking money into the firm. So I need to flip the sign. Same is going to be true for the change in long-term debt. So go ahead and copy and paste. And these are my 3s. Now, I need to look at my 4 cash flows. So in this case, off the income statement, do I have any 4 cash flows outside of net income? Because remember, this is going to be one of the tricks, but I do have minority interest. So equals the payments to the minority shareholders, the minority interest. Now remember, payouts are positive numbers. They're already listed as a positive number. So I don't have to worry about changing that sign. And then I would have my change in minority interest on the balance sheet. So this is coming from the balance sheet, and this is coming from the income statement. Equals, so for my balance sheet, it's 2011 minority interest minus 2010. Now, it just so happens that the minority interest didn't change, but let's think about our signs. Let's say it went to 400 or 400, just hypothetically. Say it went up by 100. So in this case, if we're buying, if we have more minority stakes, then we would have to change the sign basically. So I'm not going to do that because it's not on here, but we have to go back and we have to think about that sign. I don't want to mess up these statements. All right, so that's unchanged. Then we have preferred stock. Change in preferred. Equals, actually, before I do change to the preferred, probably should do the income statement first. So back to this, I have preferred dividends. Just down one line. So income statement would be the preferred dividends off the income statement. 3 years. So remember, we don't, for the income statement, we don't use net income, because remember, net income is not a cash flow. We use dividends instead of net income as the cash flow available to the investors. And so in this case, that's why we're using the preferred dividends. Now, remember, for purposes of the TII, total income available to investors, the income statement technically stops with net income or net profit. So that's why we didn't include the dividends on that statement. But we are including them here because they are a cash flow, and we track the cash flow on the cash flow statement. So then I need my change in preferred stock. So again, equals current year minus previous year equals current year preferred stock minus previous year. Now, again, you gotta think about the sign. If I add to my preferred stock, I'm bringing cash into the business. So I would need to flip this as well. Because again, it's an inflow of cash to the business if it's a negative number. So just like the minority interest and the debt above it, right? Common stock equals dividends to the common shareholders, income statement effect. It's already a positive number because it's an outflow. And then I need my change in, and in this case, I need my change in common stock at par value. We'll call it change in common stock. And paid in capital. I'm next going to need off of my TFI change in treasury stock. And I can skip the retained earnings because retained earnings is a non-cash item. So in this case, my common stock went from 700 to 700, so there was no change. But like that before it, I would need to flip the sign to represent the right equation if it were to increase. So for example, if common stock went from 7 to 750, then with a change of sign, that would represent a 50 outflow. But it didn't, so I want to undo the 750. Okay, so that's my change in common stock. And finally, my change in treasury stock. Treasury stock represents a repurchase of shares. So it's already an outflow, but it's a contra account. So basically, by going from -5 to -250, the company bought 245 of stock back from its shareholders. So that's actually a payment to the shareholders. So I need to flip the sign. And there's also an equity investment. So if I did it right, and I'll quickly know if I did it right, because my statements should balance. So that is my CFI, probably one you struggle a little bit with. But as I said, the key is to make sure we follow the process. And the process says for CFI, income statement minus change in balance sheet. We do that 4 times to get the cash flows. Second, that we're reconciling not to the cash balance, but to the cash flows. So in this case, the cash flow available to investors from operating activities, free cash flow, minus, plus, I can talk today, non-operating activities gives me CFI, and that is the cash available to pay back to my investors. When I have a positive CFI, I can distribute cash to investors. When I have a negative CFI, I have to pull cash back in from investors. Finally, we didn't get to talk about this in the last class, but we'll then do another economic analysis where we're going to look at the economic profit, or EVA. Again, we're calling this economic profit because Stern Stewart calls it EVA, and they don't want other people to do that. So in this case, we're going to look at the economic profit. And I'm going to create this as a new tab. So I'm going to reconcile the years. All right. So what I am going to do for economic profit is there's 2 methods to calculate economic profit. One is you take the spread. So I need an ROIC. So in order to calculate an ROIC, I need my notepad or noteplat, and I need my invested capital. So now you can quickly see one of the advantages of the economic statements is that it gives us the data in the format that we need to do our ratios very quickly. So that would get me my ROIC. Now, here's the difference, and a very important nuance for your grades is I'm going to ask you to calculate what's called a beginning of year ROIC, or a BOY, B-O-Y, as opposed to an EOY, which stands for end of year ROIC. And part of the reason I'm going to ask you to do this is that on your exam, I'm going to ask you to do two valuation methodologies for the final exam: a discounted cash flow and an economic profit. The only way those two methodologies balance exactly is if the ROIC is based on a beginning of year calculation. So what does that mean? Beginning of year ROIC means starting capital at the beginning of the year, which is the same as the ending capital last year. So beginning year ROIC equals the current year NOPLAT divided by the previous year invested capital. So that's beginning of year invested capital. And that would get me an ROIC of approximately 4.65% and 4.34. Just for curiosity's sake, if we were to do a ROIC based on the end of year, we would do NOPLAT divided by ending invested capital, and we would get a higher number in this case. Typically it's lower because companies are investing year to year, but this company happened to disinvest, so therefore its ROIC got better. By the way, there is an ROIC with an average capital. So NOPLAT divided by beginning plus end divided by 2. So I could do an ROIC based on beginning of year, I can do an ROIC based on end of year, and I can do an ROIC for the average of the year. And obviously you can see there's 3 different numbers. Now, for our purpose, the one that we're going to use this, I'll leave this in the spreadsheet, is the beginning of year. Now, to get my spread, I would then need my cost of capital. And my cost of capital is given to me as assumption in the model. It's 9%. So spread, we defined in the class, is the ROIC, in this case, the beginning of year, minus the WACC. We have a negative spread. So what is economic profit? EP is spread times invested capital. So in this case, it's my spread times, very important, beginning of year invested capital. So last year's invested capital, negative 150.4 and negative 142.58. Now, method number 2 that the book talks about is I take my NOPLAT and I subtract what's called a capital charge. So equals NOPLAT and then I have what's called my capital charge. Now, what's my capital charge? In this case, capital charge is if I started with this amount of capital, using again beginning of year methodology here, 3460, and I multiply it by my cost of capital. I invested 3460. Investors expect me to make a 9% return on that. Therefore, my expected level of return is the 311.4. The economic profit is the difference between what I earn and what investors expected me to earn, negative 150.4. Notice in either method, I get the same answer. Again, concept of balance. So now we're going to start getting into the analytics of the data. So we've crunched the data, we've got balancing statement. So I'm just going to call this the in-class solution so I can post this later. All right, so now we're ready to figure out what the statements are actually telling us. So first, if we start with this statement. First question we might ask ourselves, is this company creating value? Well, in order to answer that question, we can look at two things. We can look at their spread, and we can see that their spread is negative both years. And we can say at this point in time, historically, the company was not creating value because investors were expecting them to earn a 9% return, and they only earned a little under 5 and a little over 4 in the 2 years. So they were 4.3% and 4.7% below, or sorry, 4.4% and 4.7% below the threshold that investors expected to earn during that period. So they did not create value. Saying the same thing a different way. They had negative economic profits of negative 150.4 and negative 142.58. So that is how much they were short each period from the risk-based expectation of the investors, and that is how much value was destroyed during each of those periods. Now, that doesn't mean that in the future the company can't improve on its performance of its assets and get a reasonable rate of return, but for those 2 periods, the company did not meet overall average investor expectations based on the cost of capital. All right, so that's one thing that we learned. Next, we'll go back to return on investment. Where did that come from? Well, again, this is the advantage of our statements. It came from our NOPLAT divided by our operating working capital. So we're kind of getting an operating rate of return on this business. But what's interesting is we could also get a non-operating rate of return. So what I want to show you here is that from a ROIC perspective, and I think I have enough columns here. So I'm going to use the years just repeating. Let's see. I'm going to use the years repeating up here. And what I'm going to do is I'm just going to add in, I'll do it right here. Add in my NOPLAT just so I can see it from the other page. And if I take my beginning of year ROIC equals NOPLAT divided by, actually I can't do that year, equals NOPLAT divided by previous year's invested capital. That's the same number we had on the other page. So that's kind of like the operating return of the business. Again, let's just do it to one decimal place, make it a little bit easier. 4.7%. Now here's the thing. This company also earned, we'll call this non-operating income. And the non-operating income would have been the total income available to investors would have been these non-operating items. It would have been the interest income, which year is this? 2010. Plus the non-operating income. That's how much non-operating income after tax this company was able to earn and achieve. Try to keep it all on one page. All right. So here's the thing. Total non-operating we'll call it non-operating capital equals excess cash plus equity investments minus other long-term non-operating investments. So that's how much money they're financing for non-operating investments. So my beginning of year other, we'll call it my non-operating ROI. It's not really invested capital. Basically, my return on investments on non-operating items equals that divided by that. So my return on TFI equals, it's going to be really the no plat plus, well, we're saying this, I already did it, is my total income available to investors. We'll do it based on last year's. Total income available to investors divided by my 2010 TFI. So here's the point of the mechanics of this exercise. Return on TFI, which is the return on the operating and the non-operating assets, which equals the debt and equity of the cash flows. This is what Bloomberg / Cap IQ call ROIC. This is what the rest of the world calls ROIC, return on TFI, because they do a return on the debt and the equity investments. The idea is that this is the amount of money that's invested that requires a return, and this is what was invested. The difference or the nuance is that what we're going to do is we're going to break out this average 5.1% rate of return into operating and non-operating. So the company earned 4.7%, actually doing what it does as a business, just happened to do well investing in non-operating investments. And earned a much more reasonable rate of return, not running its business, doing other stuff in the year 2011. In the year 2012, the operating performance went down a little, but what really hurt the business is its non-operating performance went down a lot, from 11% to 4%. What we're going to care about when we analyze a business is really this trend. What is happening to the core of the operations of the business? Now, in both cases, the performance went down, but most of the performance that went down was actually here in terms of overall rate of return. But this is why we invest in the business. We're investing in the business to understand its operations. So this is part of the insight of why we're separating out the statements and what it will tell us about the business, because what we really want to understand is what is the return in the operating items, what is the return in the non-operating items, what is the overall rate of return in the business. And so in this case, we can clearly see that the business performance is worsening, which is also coincidentally while they are destroying value. And then step 3 is, what does the cash flow statement tell us? Well, in 2011, we can see that this company wasn't really investing. They generated about $380 million of gross cash flow. They disinvested in working capital. They barely spent any CapEx. They also didn't pay some of their bills. And that allowed them to essentially take cash out of the investment in their business. That was a very small acquisition. So their gross investment actually added to their operating cash flow, and they generated a lot of free cash flow. Now, they then took a lot of this cash flow, put some in the bank. They bought, because I can see a negative, they bought a stake in another company, which was probably helping their non-operating income. But in any event, I had 213 to pay out to my investors. What did I do with the cash? Well, 43 went to pay interest. I actually borrowed negative 160. So clearly I didn't need to borrow to pay the interest because I made enough to pay the interest. So what are they really doing is they're using most of this borrowing because they paid out some money to minority shareholders. They paid out a little bit of dividends, preferred and common, but they're really using it to help fund a share repurchase. So if you really think about it, the 213, 160 of the 213 was needed to borrow. On top of that, because of all the payouts they made, including this big buy of treasury stock, which was actually greater than the cash flow available to investments. So during poor performance, this company didn't really invest a lot, and it chose to return some cash back to its investors. Now, what happened in 2012? 2012, a little different. 2012, the company went into a heavy investment mode. How do I know that? Because they invested 748 and they only brought in 393. So this is where we get into the idea of the reinvestment rate, which is for 2011 and 2012 is the gross investment divided by the gross cash flow. So basically, their reinvestment rate was negative 47% in 2011 and was 190% in 2012. So what we just summarized in the cash flows, we can quickly see in the reinvestment rate. This company performing poorly in 2011 basically disinvested in their business, where 2012, they're making a big long-term future bet. They're taking 190% of their cash flows from operating cash flows, and they're reinvesting it back in the business, which is why they have negative free cash flow. And in this case, they further put some of this cash flow back into savings. They grew their cash balance both years, leaving less CFI to be available. And most of the reason why it's available is because they sold off some equity investments and they got some cash by not paying their long-term liabilities. So in this case, I gave them negative 227 of cash that they needed to finance. Where did this come from? Well, you can see clearly in this year, most of it came because they issued some long-term debt. So this company issued some bonds to basically finance its long-term negative cash balance. It also paid off some short-term debt, because that's a positive number, and some interest expense. So basically with interest and pay off of short-term debt, that was about 100. They paid some minority interest. They paid some preferred, paid some common. They still bought back some stock. So timing of the issue. And they basically borrowed some money to help them afford to buy back the stock. So that's really what we can clearly see here. In this year, they could afford to buy back stock. Question is, how much they buy back? They borrowed more to continue buying back, greater than the CFI. In this year, they clearly couldn't afford to buy back the stock. They had negative CFI, but they kept doing it. And the reason that they kept doing it and paying the dividend is because they borrowed from the bank to do so. So clearly, if this trend continues, we see a troubled company, not creating value, struggling with it now, its cash flows, making a big bet on the future of the business. Right? But that's the point, is that to truly evaluate this company, we would have to look to the future, because obviously they're in investment mode, and we can clearly see that now with the rearranged cash flows. So maybe there is a change that they see in the future that caused them to invest. So before we wrote this company off, that's what we would have to find out. But this would alert us that there's been some sort of change in the prospects of the business by just starting to understand the financials. So if we were to have a call with management or be on a conference call, then we could quickly ask some questions to try and ascertain. And we've already got the questions ready to frame. So this is, again, going to get into more of what we're going to cover this week as we go through these various statements.